Welcome to the Explainer from Finvot Insights. Today, we are deconstructing a very popular tool for income investors, the Covered Call ETF. We're going to look past those massive advertised yields to uncover the hidden costs that often go unmentioned. You see a number like this, and it is impossible not to pay attention. It promises an incredible level of income, an opportunity that seems too good to pass up. And that's exactly what this is. 84% represents the advertised distribution rate from a single, very popular covered call ETF. For any investors searching for yield, a figure like that is profoundly tempting. But this raises the most important question of all. What are you giving up to get that income? To find the answer, we will be examining the significant trade-offs inherent in these strategies, using an expert critique from hedge fund manager Benn Eifert as our framework. Let's begin with the central argument from Benn Eifert, who is the managing partner at QVR Advisors. Eifert's argument is quite blunt. He contends that a strategy which was once a niche play has now become an overcrowded trade, especially for retail investors. This, he argues, makes it a fundamentally flawed approach in today's market conditions. You see, to understand his point, we have to look at how the market has evolved. Before 2010, the options market was a niche space, where sellers could earn what are called high-risk premiums, essentially extra compensation for taking on risk. But around 2012, big institutional players entered, and that edge began to erode. Today, a massive flood of retail capital into these ETFs has depressed the very premiums that these strategies rely on to generate returns. To truly appreciate this critique, one must first understand the core mechanic of the covered call strategy itself. At its heart, selling a call option is what is known as a short volatility trade. Put simply, you are making a bet that a stock's price will remain relatively calm. You collect a small, consistent premium when things are stable, but the strategy is explicitly designed to miss out when the stock price makes a large upward move. This slide illustrates the fundamental bargain perfectly. In exchange for that small fixed premium, you are forfeiting the potential for significant, sometimes unlimited gains if the stock soars. But here's the crucial part. You retain almost all of the downside risk if the stock price falls. You have effectively capped your reward without meaningfully capping your risk. This isn't just a theoretical concept. The long-term performance data reveals exactly what this trade-off costs investors over time. Let's compare the Global X S&P 500 Covered Call ETF, ticker XYLD, to its underlying benchmark, the Vanguard S&P 500 ETF, or VOO. Since 2013, the total return for VOO is 405%. For XYLD, it's just 143%. That is a substantial opportunity cost. The performance gap is even more pronounced when we look at the Nasdaq 100. The covered call ETF, QYLD, has a total return of 138%. This number is completely dwarfed by the 639% return you would have achieved by simply owning the underlying index ETF, QQQ. Now let's see how this structural performance drag plays out in some of the largest and most popular funds that investors are buying today. Even the behemoth in this category, the JPMorgan Equity Premium Income ETF, or JEPI, which is the largest actively managed ETF in the world, cannot entirely escape this dynamic. This comparison reveals some important nuance. While JPI does offer some downside mitigation, falling less than the S&P 500 during a market decline, its total return since inception has significantly lagged. What's more, during that same downturn, a standard low-volatility stock fund like USMV actually provided better protection. This performance trade-off becomes even more dramatic when the covered call strategy is applied not to a broad index, but to highly volatile single stocks. Let's look at the YieldMax MSTR Option Income Strategy ETF, MSTY. Despite its headline-grabbing yield, it has sharply underperformed its underlying stock, MicroStrategy. In just the few months since February 2024, its total return of 272% lags considerably behind the 420% gain from simply owning the stock itself. So, with all of this data in front of us, what is the crucial takeaway for an informed investor? Eifert's warning isn't that selling options is always incorrect. The critical point is that participating in crowded trades that are promoted without a full discussion of the context and trade-offs is, for most people, a losing proposition over the long run. And this analysis ultimately leads every income investor to a fundamental question they must answer for themselves. What is the primary objective of your portfolio, and what compromises are you truly willing to make to achieve it?
If you found this analysis valuable, please like this explainer and subscribe to Finbot Insights. Your engagement helps us to continue producing clear, data-driven financial content.